you've been checking your portfolio lately and feeling like you're on a roller coaster with no seatbelt, I totally get it. Stock markets are swinging like a pendulum, and more recently, we've seen volatility with massive one-day declines of more than 5% on the S&P 500. We've even seen days where the market is down roughly 4% intraday, then up 3%, then back down again, all in just one trading day. It's been a wild ride, mostly due to tariffs, inflation potentially rising because of tariffs, Doge, and now further geopolitical tensions. All of this creates one of the worst things possible for the market: uncertainty. But before you start panicking and packing up your retirement dreams, we're going to talk about how you can handle this volatility, especially if you're nearing retirement or just entered retirement where the stakes are much higher. And spoiler alert, it's not as bad as it seems, as there will always be some form of uncertainty. Stick around until the end, where I'll briefly talk about what my team at the Clark Group does during periods like this to help manage portfolios for retirees. Also, the principles and concepts I'm going to discuss in today's video applies for future declines as well, because even though history doesn't repeat itself, it does tend to rhyme. And if you want to see more content like this in the future, don't forget to hit that subscribe button. This video is intended to provide education about different financial planning topics and should not be considered as financial, legal, or tax advice. And of course, past performance is not indicative of future results. First things first, let's briefly talk about what's going on right now. This video is being recorded in April of 2025, and as of this recording, the S&P 500 has declined about 15% from its peak, which is the fifth fastest correction on record. And the NASDAQ is down over 20% from its peak, so it's in a full-fledged bear market. So why is this happening? Well, tariffs were hit on over 50 countries and at levels much more extreme than originally anticipated. This means that we don't know what the long-term impacts will be on the economy. Could this cause higher inflation, more conflict globally? Maybe it will be beneficial to the US economy. Point being though, this is creating a big bag of uncertainty. The market loves good news. I always tell clients this. It can sometimes even take bad economic news somewhat well, depending on what it is and what the outcome will be. But the market absolutely hates the unknown, and only time will tell how tariffs will impact the economy. But let's take a deep breath, because this too shall pass. Markets have been through this before time and time again, and it will likely happen again throughout your retirement. We will see more 20, 30, 40, or even 50% plus declines in the market. History shows us though that crashes happen, tariffs even happen, really bad news happens. But you want to know what also happens? Rebounds. Yes, the market may stumble for stretches, but historically it has never stayed down forever. Remember Black Monday on October 19th, 1987?
Nobody even expected it to be down this much.
Remember the tech bubble in 2000? What about the financial crisis in 2008? What about COVID in March of 2020? Well, all of these periods in the moment felt like we were headed for a never-ending decline. Now, even though some of these periods were much more severe than others, the market has come roaring back every downtrend. It's just a matter of time. Is it a few weeks, few months, maybe even a few years? That part nobody knows. But to put things in perspective a bit deeper, the reason why we experience these types of swings or fluctuations is due to the premium returns that stocks have historically generated. Depending on the time frame you focus on, the S&P 500 has historically generated a roughly 9 to 10% average annual return. Emphasis on average. That means that some years we'll see markets go up 20+%, while other years the market goes down maybe 10, 20, or even 30%. That's just the reality of investing in equities. So as an example, if somebody were to ask you, if we had 3 years of market performance, one of those 2 years the market's up 27% on a total return basis, 1 year the market's up 24%, and then 1 year it's down by, let's say, 15%. Would you take that? Well, any rational investor would likely say yes. Besides major crashes, do you know what the average intra-year market decline is? Well, according to JP Morgan, markets drop by about 14% on average within a given year. Yet the market has still managed to rise in the long run and finishes up for the year significantly more than it does down. That means when the market drops, it's just part of the process. It's like the market's way of going to the gym, getting stronger and healthier after each dip. Now, if you're nearing retirement or already retired, you're probably looking at the market and saying, yes, this is all true, Brandon. I know I've been here before, but isn't the worst time for me to be taking a hit on my investments when I retire? What if I need to start taking distributions from my nest egg right after I retire? After helping hundreds of people plan for retirement, we know that the stress is real. The stakes are much higher once you enter your distribution phase. The main reason, when you're at or near retirement, sequence of returns risk is a big factor. It's essentially a way of saying that if you happen to retire right before a big market downturn, the sequence of your returns, that is the order in which your investments rise and fall, can have a much bigger impact on your portfolio than just the returns themselves. Let's say you're withdrawing from your retirement savings and the market tanks. If you're selling investments at a loss to fund your lifestyle, you're locking in those losses and eating into your nest egg. But if the market recovers quickly and you're able to wait it out without having to sell in a panic at depressed levels, you'll likely be way less impacted. In other words, imagine you're trying to fill up your bathtub. The faucet is flowing, but someone keeps pulling the plug out of the drain. The water level rises and falls unpredictably. Well, if you're pulling from your retirement account during a market drop, you're draining your savings faster than it can fill back up. But if you just give it a minute and you avoid making withdrawals while the market is down, you can let the water fill back up again once things stabilize. Now, why do I mention this? Because having a retirement plan and strategies within your portfolio to help withstand volatility and sequence of returns risk is extremely important. Periods of heightened volatility teaches us that diversification is crucial, and it's a real benefit to investors long term. When you're in the wealth accumulation phase, you're owning, let's say, 100% in stocks, it's likely going to be the best outcome long term due to compound interest. However, once you are in retirement and you're pulling funds from your portfolio, you essentially want positions or different asset classes that are not as closely correlated to one another. That ultimately helps create diversification. Another way to put it is that you want certain positions or asset classes within your portfolio that, let's say, zig while others zag. So what types of asset classes am I referring to? Let's say fixed income, alternatives, or even strategies that help mitigate risk for stocks. Even certain stocks can have lower or negative correlations to one another. So this ultimately creates diversification and helps lower your drawdowns during market drops. It can even help tame emotions while in retirement because you do see less declines for your portfolio with diversification. All right, so how do you stay calm through the volatility even if you are diversified? First, let's talk about control. You know what's going to be unpredictable? The stock market. What's also unpredictable? Life. It throws us curveballs, and sometimes we don't even see them coming. The problem with trying to tame emotions in the world that we live in is that anytime we open our phones or turn on the TV, the media is in our face about how volatile the market is. The media will latch onto any negative news any chance that they can because bad news sells, not good news. Have you ever noticed that when the market is down, headline font size is 2 to 3 times larger than what it normally is because that grabs attention? So one of the best things that you can do during extreme periods of volatility while in retirement or leading up to retirement is to tune out the media and focus on your life. Maybe spend more time with your family, work out more, try new hobbies, maybe even enjoy nature. The world is beautiful. Point being, focus on things that you can control, not the uncontrollable. Tariffs, can't control them. Global tensions, not our call. So there's a lot in life that we can't control, especially the market. And guess what? That's okay. What you can control, though, is your reaction and how you deal with the bumps along the way. Here's the silver lining, though. Focusing on what you can control, like your retirement plan and how you react to downturns, makes a huge difference. Are you utilizing Roth conversions? Are you tax loss harvesting? Are you focusing on lowering your expenses in the event that maybe we do enter a recession? Maybe even buying the dip with rebalancing. So these are all things that can help you weather through these storms. And you know what? You've already done one of the hardest parts. You've saved diligently for years. You may have a high 6 or 7 figure portfolio, and that's huge. Most people don't have that. So maybe you're already diversified with your investments. Great. Maybe you've got an emergency fund of 6 to 12 months for retirement. Fantastic. Maybe you already have strategies that take out some of the volatility from your retirement savings during a rough patch in the market. Bravo. All of this adds up. So what can you do? First, let's stop worrying about things outside of our control. We can't change tariffs or the market's next move, but we can be intentional with our retirement strategy. Second, focus on the long term. Markets go up and down, but your goal is still 5, 10, 20, or even 30 years down the road. So when volatility strikes, just remember it's not about the daily fluctuations, it's about the long-term picture. You are probably in a much better financial position now than you were 5, 10, and even 20 years ago. And that's likely to be the case 5 and 10 years moving forward. Now I get it, seeing those red numbers on your screen can make your stomach do backflips. But remember, these dips, they're normal. So if you've got a financial plan in place, this is just a temporary situation. So the next time the market takes a dive, remember, you can't control the waves, but you can learn to surf. Stay calm, stay positive, and keep your eyes on the horizon. These dips are just part of the ride, and you're prepared for it. During these periods of extreme volatility, focus on staying calm and use this as a time to figure out if your true risk tolerance matches your current portfolio. We often find with potential clients that that's not the case. And if not, adjust only when the timing is right, usually once the market recovers. So you're avoiding emotional moves. If you don't feel confident in your portfolio or retirement plan, my team is here to help. We work primarily with professionals to help them plan for retirement or are already in retirement, and we help them manage their retirement investments in the most optimal way specifically for them. We build out retirement plans covering all areas of your finances, not just your portfolio. In addition, we do utilize different strategies like strategic and tactical strategies to help with these downtrending periods. In other words, just like diversifying across asset classes, we also believe you should diversify with investment strategies for retirement because not every bear market is exactly the same. If you'd like to learn more, we can have a conversation around your portfolio and retirement plan and see how we can help you maximize your retirement. It's a free session to learn more about your financial situation and see if our team of advisors and CFP professionals can help. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more content like this in the future. Thanks so much.